You've probably seen traders using one or two wave lines on a chart to determine entry points to secure profits. That is the moving average, and in this video I'm going to show you how you can use this tool to change your trading game and start being profitable. This video is divided into 3 parts. We start first with some basic knowledge in moving averages, then head straight to the moving average crossover strategy, then to the moving average dynamic support and resistance strategy. Make sure not to skip any parts because every point is vital to making you a master of this strategy, and I promise you that by the end of this video you'll start making some real money in the market. Now, I know you want to head straight into the strategy chapters, but this part is also important for you in having a general idea of the concept of moving averages. Don't worry, I'll make it quick. A moving average is simply a way to smooth out price fluctuations to help you distinguish between typical market noise and the actual trend direction. As you already know, trends do not move in straight lines, price zigs and zags, so a moving average helps smooth out the random price movements and helps you see the underlying trend. Generally, the smoother the moving average, the slower it is to react to price movement, and the choppier the moving average, the quicker it is to react to price movement. The length or the number of reporting periods included in the moving average calculation affects how the moving average is displayed on a price chart. The shorter its length, the fewer data points that are included in the moving average calculation, which means the closer the moving average stays to the current price. The longer its length, the more data points that are included in the moving average calculation, which means the less any single price can affect the overall average. Now, let's move to the two major types of moving averages. The simple moving average, usually referred to as the SMA, and the exponential moving average, or the EMA. A simple moving average is the simplest type of moving average. It calculates the average price over a specified period, typically using closing prices. If you plotted a 5-period simple moving average on a 1-hour chart, you would add up the closing prices for the last 5 hours and then divide that number by 5. Now you have the average closing price over the last 5 hours. String those average prices together and you get a moving average. On this chart, we've plotted 3 different SMAs on the daily chart of GBPUSD. As you can see, the longer the SMA period, the more it lags behind the price. Notice that the 62 SMA is further away from the current price than the 30 and the 5 SMAs. There is one problem with a simple moving average. They are susceptible to spikes. When this happens, this can give us false signals. We might think that a new currency trend may be developing, but in reality, nothing has changed. Now, let's move to the exponential moving average. An exponential moving average, or the EMA, is a type of moving average that gives greater weight to the most recent price data, making it more responsive to new information compared to a simple moving average, or the SMA, which weights all data points equally. In contrast, the SMA gives equal weight to all prices in a selected period, so a large spike from the price continues to influence the average until it drops out of the calculation window. The EMA is generally more effective at minimizing the lingering effect of past price spikes and providing a more current view of price trends. Let's take a look at the 1-hour chart of GBPUSD. Notice how the yellow line, which is the 30 EMA, seems to be closer to price than the white line, which is the 30 SMA. This means that it more accurately represents recent price action. So by now you're probably asking yourself, which is better, the simple or the exponential moving average? When you want a moving average that will respond to the price action rather quickly, then a short period EMA is the best way to go, but the con is it is more prone to cause freakouts and give errant signals. When you want a moving average that is smoother and slower to respond in price action, then a longer period SMA is the best way to go, but the con is it is slow moving, which may cause lag in buying or selling signals, causing you to miss out on some trades. Now let's head to the part you've all been waiting for, the strategies. The first strategy is the simple moving average crossover strategy. A trend can be defined simply as the general direction of the price over the short, immediate, or long term. Some trends are short-lived, while others last for days, weeks, or even months. But you don't necessarily know how long a specific trend will last. A powerful technical tool known as the moving average crossover can help you identify when to get in and out. A moving average crossover occurs when 2 different moving average lines cross over one another. Because moving averages are a lagging indicator, the crossover technique may not capture exact tops and bottoms, but it can help you identify the bulk of a trend. A moving average crossover system helps you to answer these 3 questions. Which direction might the price be trending? Where might be a potential entry point for a trend trade? And when might a trend be ending or reversing? All you have to do is to plot on a couple of moving averages on your charts and wait for a crossover. Before we take a look at some examples, I recommend you get a notebook or a piece of paper to write some key information as I explain every aspect. This part is where the real game begins, so I need you to be very attentive. Let me take you through some real scenarios. Now, before we go through this example, note that your target profit should be calculated from a risk to reward ratio point of view, with the lowest being the 1:2 risk to reward ratio. However, if there's another crossover before reaching your target profit, close your trade and take that profit right there. You understand what I mean shortly. Your stop loss should be the recent high or low depending on the trend. I will demonstrate. So in example 1, we wait for the market to present us an opportunity. With the first crossover, the candles to trade for my a bit above, which means the RX is high, but we can still trade it. If we enter the market at this candle close, our stop loss will be placed a bit below the recent low as indicated. Then we will target a risk to reward ratio of 1:2. After some few candles, we see another cross close to our entry point. This shows that the current trend might be ending. So what do? We close the trade and re-enter in the opposite direction, setting our stop loss above our previous high and targeting 2 times our RX. In this case, the market hits our target profit. Assuming you had a longer target profit, you would have to close the trade after seeing this crossover. Now, what do you think we should do after this crossover? We enter the trade again in the opposite direction, setting our stop loss below the previous low and our target profit of 2 times our RX. The market trends up and hits our target profit once more to complete the session. In the second example, we see another crossover that is far from its corresponding candle, meaning the RX is higher in this trade. We make an entry at this candle close and set our stop loss at the previous high and our usual target profit of 2 times the reward. Unfortunately, we see another crossover, which means we have to close the trade and open a new one in the opposite direction. So we open a long position while we set our stop loss and target profit. We get another crossover right after, meaning we have to close and enter a new one. It doesn't matter whether you're in profit or loss. Whenever a crossover occurs while in a trade, you should exit. This will help limit your losses. So we close the trade and take the loss and open a new trade in the opposite direction. As usual, stop loss a little above the previous high and target profit of 2 times the RX. The market got really close to the target profit, but it wasn't able to hit it. However, after seeing the crossover, we close the trade and take whatever profits we made and make another entry. Nice and tedious, isn't it? After setting the stop loss and the target profit, the market shoots up and hits our target profit this time around. What started out as a bad day in the office turned out to be a great one. So remember that when you face a similar situation, allow the market to do whatever it wants and eventually some trades will go well for you. It's normal to take losses because you can gain all that back in a single trade. I'll be creating an advanced course that will make you trade with this tool much better than you are now, with better confluence, better entries, and the ideal times you shouldn't trade at all. So do well to subscribe and turn on notifications so you don't miss out. If you want an already created SMA crossover tool right now, head over to TradingView, click on Indicators tab and search for SMA Cross, then choose the one created by Silent Chat. This is where the basic knowledge you gained from the theory I explained earlier comes in. You can set the lens to your own preferences to match your trading style. You can also change the weight of the lines to make it more visible on the chart. I prefer the 10 and 20 SMA for most pairs, by the way. One thing to take note of with the crossover system is that while they work beautifully in volatile or trending markets, they don't work so well when the price is ranging. You will get hit with tons of crossover signals and you could find yourself getting stopped out multiple times before you can catch a trend again. Just make sure not to trade with it when the market is ranging. The second strategy is to use moving averages as dynamic support and resistance levels, but instead of the simple moving average, we will use the exponential moving average. It's called dynamic because it's not like the traditional horizontal support and resistance lines. They are constantly changing depending on recent price action. There are many forex traders out there who look at these moving averages as key support or resistance. These traders will buy when the price dips and test the moving average, or sell if the price rises and touches the moving average. Now, for a beginner's approach, I recommend you try it in a 15 minutes time frame with a pair like GBPUSD. The best settings to use for a simple but effective dynamic support and resistance is using the exponential moving average with the length 50. Let's take a look at some examples. In this first example, you can see price struggling to break the EMA 50 line to the upside. The best way to trade this strategy is with candlestick patterns. You can't just enter when the price bounces off the EMA line because it can give false signals at any given time. So in this example, we spot an engulfing candle here. That's where we make our entry. We then set our stop loss as usual a bit above our previous high. Now before you set your target profit, this strategy, unlike the crossover, won't give you a signal when the market is about to change its trend so you can exit the trade. It's either your stop loss or your target profit gets hit, so it's ideal to increase your reward a bit so that a win can compensate for the losses you might face. To be more safer, you can set 3 take profits and trail or close some trades in profits before you get to the last one. The first take profit is the same ratio as the RX, the second take profit is 2 times the RX, and the third take profit is 3 times the RX. In this case, I will use a reward of 3 times the RX as the final take profit with take profit 1 and 2 in mind. Price moves down through our first and second take profits and hits our third take profits. We could have trailed this by moving the stop loss to the preceding take profit as the price dips down, or we can close in on some profits at take profit 1 and 2 and let it run till it hits the third take profit. After ending our first trade, we spot a touch to the EMA line with an evening star formation. We enter the trade and set our stop loss a bit above the recent high and set our 3 take profits. Price broke through our first take profit. In this case, if you are trailing, you have to wait for further confirmation before you move your stop loss to the first take profit. If you are not trailing, this is the time to close some trades in profit. Price further moves down. This is when you can move your stop loss to the first take profit if you are trailing. Price now hits our second take profit. This is the time to again take some profits if you are not trailing. However, price didn't continue to our third take profit. In this case, if you are trailing, your trade will end after the price hits your stop loss at the first take profits level. If you are not trailing, there might be some open positions left, so you would have to wait. This is where the confusing part comes in. As you can see, price shoots above our EMA line, suggesting an uptrend is emerging. Price comes back to touch the EMA line and creates an engulfing candle. If some of your positions are left open, there are 3 ways to draw a conclusion. You can close your previous position and open a new one, or you can hold on to the previous position and not open a new one, or you can simply have both of them open. The best way to trade this is to open a new position in the new direction and still maintain your already opened position. Trading is a game of probabilities. It doesn't matter if you have the best strategy, you can't always win. Having 2 on each trend gives you a higher probability of one working, knowing that either will cover for the loss of the other and even add some profits. This case is special. It doesn't mean you should always open a position in 2 directions whenever you don't know where the markets will go. After an entry with a stop loss and take profits in place, price went up through our first and second take profits and hit our third take profits. For the trader who has some trades open, yes, your stop loss will get hit, but you also made some massive profits to cover that loss. And also, you would have already closed some trades in profit previously. In the second example, using the insights gained from the first example, an entry would be made after price touches our EMA line and forms an engulfing candle. Price only surpassed our take profit 1, but in this case, if you had open positions, market would take you out before a new opportunity presented itself. If you were trailing, there would be no loss and no profit because you would have shifted your stop loss to your entry level after price tried moving down again. Next, another opportunity appeared after price was hugging the EMA line before an engulfing candle formed. With the same principles, you set your stop loss and target profit, and you either trail or take some profits at each take profit level. Price went all the way up and hit our third take profit. The dynamic support and resistance are just like the normal support and resistance lines. This means the price won't always bounce perfectly from the moving average. Sometimes it will go past it a little bit before heading back into the direction of the trend. There are also times when the price will blast past it altogether. An alternative as a forex trader is to plot 2 moving averages and only buy or sell once the price is in the middle of the space between the 2 moving averages. The area is called the zone. As you can see in this example, an entry can be made after price got in between the EMA 50 line and the EMA 90 line and presented an engulfing candle afterwards. That will do it for today. I'll be making an in-depth tutorial on more advanced moving average strategies soon. So if you enjoyed this video, don't forget to like, comment, and subscribe for more trading strategies to help boost your trading game. Remember to turn on notifications so you get to see my videos right on the spot when I upload them. Until then, happy trading week and may the pips be in your favor.